Matt, this is one, like I said, every time I love taking a look at this because it shows clearly how much, I guess, our economy news and the outlook is changing because we base a lot of that here in terms of what the Bank of Canada is going to do. And now it does look like we're going to stay at 3% in March, whereas before we might have got that cut. That's been pushed back a little bit till April, where we'll probably come down to 2.75. But the change here from our last one is that we might actually get down to 2.5, which is 68% chance at the July meeting. And earlier, or I'd say in the fall of last year, it looked like 2.5 was going to be a very realistic thing. I know Ron Butler was talking about that, and then that kind of came off the table a little bit, and now we're back on. So I think it's one of those things, like it's ever changing, right? But if this is the change that we see, we are going to see rates continue to come down, specifically when we're looking at the Bank of Canada.
We are. And they're going to come down to about 2.5%, and we'll see in later charts just how that stacks up to how interest rates have been in the last 20 plus years. But
Yeah.
this was pulled on February 9th. The U.S. CPI data just came out today, and it was relatively strong. And there was some talk on some online forums that expectations out of the U.S. was that they might get a rate cut in September, but now that's been pushed to December because of the strength in the CPI data this month. So it'll be interesting to see how this chart readjusts to this. But I think it's fair to say that we can for now expect. I think it's fair to say this year we're going to get 2 cuts. When they'll come will depend. But as of right now, like you said, we'll get one in April and we'll get one in July. And as far as that, we'll have to see how everything readjusts. But yeah, it'll be interesting to see next week how it adjusts to the U.S. CPI data if they push it out a little further to maybe June and July rate cuts instead of April. But
yeah, interesting. It could be, and I mean, we've talked about how they like to do that in the past because they don't want to inflate anything during the spring market. So it could be delayed. Maybe that April one does move to.
I don't know. Maybe they will do something in March if these numbers persist in February for the housing market.
Yeah, they won't be as worried about it. They'll be like, okay, I think we can throw the real estate market a bone here. At the bottom here, we have a basket of 10 lenders, including CIBC, BMO, TD, Scotia, RBC, National Bank, Desjardins, on and on. And just look at the change here. Like all these rates, again, because it's the average of 10 lenders, you can beat this in other places. But the important thing to note is the 30-day change in these averages is, we're down 25 basis points for our 1-year fixed. Looking at our 5-year fixed as well, down 25 basis points. So we're starting to see that movement in the fixed rate market as well, which is where a lot of people feel most comfortable. There's been a couple of great videos out there recently that I've watched where people have been betting well in terms of the variable rates as well, for those people that are open to a little bit more risk or feeling a little bit more savvy. And then seeing these drops here in their fixed rates, they're coming out now below where they would have when they had to close last year. So if you're open to risk, there's ways that you can still beat the market in terms of the amount of interest you would pay on your loan. But at the end of the day, if you're feeling more comfortable in a fixed rate environment, it's nice to see these drops happen. Yeah. All right. I don't know what I pressed there. When we take a look at the policy rate forecast for the big banks, Matt, talk to me this one. And I almost want to start with RBC because we talked about them at the beginning of the broadcast here. And like you said, who's got the most to gain from a forecast of a 2% rate coming Q4?
I mean, that's RBC. If they're the only ones doing these large blanket, and we don't know if other banks are doing it. The only stories that we've heard through the Globe and Mail and some other people reporting is that it's primarily RBC. And it's funny enough that they're down at forecasting 2% by the end of the year when you've got BMO at 2.5. You've got Scotiabank holding steady at 3% all year long. You do have TD Bank and National Bank and CIBC down to the 2.25 range.
Mm-hmm.
I personally, my call is maybe 2.5. This is all assuming there's no tariffs. if tariffs come into play, this is a completely different story. They're going to have to stimulate the economy. But it is interesting to see that RBC has, because what would 2% do for RBC? Well, if they did do blanket mortgages, it would, a 2% rate would definitely potentially do an uptick in prices.
In the market. Yeah.
And that would help lessen the blow of these net negative mortgages that they have out
Yeah.
there.
Yeah. Yeah, I agree 100%. And it's funny seeing Scotia hovering there at the 3% the whole way through, because Scotia, it was one of their economists that came out and said, hey, if tariffs come into play, maybe we combat that with raising rates. So it's funny. Everybody's sending their messages. I think that's one thing that we talked about last time is you got to take all this stuff with a grain of salt. All these banks have their own portfolios and their own interests to serve with some of these forecasts.
I thought it was interesting for Q4 2020, the last column there, that
Yep.
National Bank, they went as low as 225 in at the end of this year, but they have it going back up to
Back up.
275 at the end of 2026.
Yeah. And that's a great thing to point out because they're the only one that then said rates go back up the following year from a
Yeah.
year later of the end of 2025. So it's interesting to see. Looking at our bond yields here, which impact our fixed rates, you can see this downward trend. Now we did have a little uptick there earlier in the year, but has continued to come back down, which is nice.
Yeah, we had an uptick today because of the US CPI data. So it did bump up. But going back, we're still as high as we've been since 2011. So when we were
Yeah,
looking at the data points for 2018 and 2019, we can see where bond fixed, the 5-year fixed was in
yeah,
2018 and 2019. And, that was a restrictive area for the real estate market. The market was down and soft during that time.
yeah.
And we're still well above that as well. And even if we get another 50 basis point cuts, this might bring us back to where we were in 2018 and 2019. And it's still a bit of a restrictive area for growth.
Yeah, I think that's important to note. And again, if anybody's been telling you that we're going to see those big turnarounds in the spring market, well, look at where we were back then when that stuff was happening, right? We were under 1% for the most part when we saw all those big pushes in the housing market.
Yeah.
So important to note. Again, when we take a look at where we are in terms of our interest rate for the central bank, the Bank of Canada, hovering now at 3%, looking at potentially getting to 2.5. And like you said, that comes back to more financial crisis hovering around 2009, fall
Yeah.
of '08 there, right?
And it keeps us, we're still going to be well above where we were 2018, 2019 again for those
Yeah.
rates.
And again, when talking about people that are refinancing in both of these charts, I'll go back to the other one in just a second. Look at where we were in 2020 to 2022 when the bulk of those purchases were happening, both pre-con and in the resale market. The resale market in particular saw some of the highest sales volume we've ever seen. 2022 or 2021 clocking it at 120,000 sales, whereas we finished below 70,000 last year. I think that's important to note. And same thing when we look at the bond yields from that 2020 to before 2022. Now we're upticking a little bit in that fixed rate environment before 2022 hit. They're ahead of the game. They're usually ahead of what the Bank of Canada is doing. They saw the signs beforehand and started increasing there. But this is where we were back then. And so anybody that's refinancing now, we're looking at a drastic change. And this is the other warning sign in the market is the amount of people that are refinancing are coming in at a much higher rate than when they purchased. And we're seeing the bulk of that. I think among the top 6 banks, we were looking at 80% increase in renewals from this same time frame last year is what we're looking at. And we're looking at these high rates still.